Hey guys, it's Ali here with Global Trading Team. Just want to touch base with everybody here. I know many of you guys have been asking about what goes into an option contract. What are option contracts? How do they work? What's a call? What's a put? What's premium? All of that good stuff. So let's try to jump right into it. I'm going to go ahead and screen share. Uh, what I have here is my chart. So I'll just pull it up here. Hopefully this is up for you guys to see. Take a look here. And desktop 1 should be here. All right. Well, hopefully you guys are seeing what I'm seeing here. So this is just a simple, basic TD Ameritrade Thinkorswim platform. I like TD Thinkorswim for many reasons. It offers pretty good execution for the most part. It gives me a pretty good charting for technical analysis. I use a bunch of different studies here. The charting is pretty simple, pretty self-explanatory for the most part once you get the hang of it. It just gives you a lot of different ways to trade comfortably, know what you're looking at all times. It's pretty simple in terms of just like accessibility and getting to where you'd like to get to on your chart. So let's talk about option contract. What is an option contract? Option contracts are financial instruments that are derivatives based on the value of underlying securities such as stocks, okay? An option contract offers the buyers the opportunity to buy or sell depending on the type of contract they hold. So two types of option contracts, right? There's a call option and a put option. Many of you guys are familiar with call options. Call option is basically when you go long on a stock, when you're anticipating or speculating that the price of the stock is going to go higher. So that is called a call option. What is a call option? It's basically an option that allows the holder to buy the asset at a stated price within a specific time frame. The put option is the exact opposite. It allows the holder to sell the asset at a stated price within a specific time frame. So if you're looking to position yourself, let's say on a stock, and let's just move here. I'm just using IDEX right now. We don't really trade IDEX all the time. It is more of a momentum play more than anything at the moment. The fundamentals could be there. It's a little too early for us to tell, but it was on there for prior analysis or previous analysis we were doing earlier with the team. So using the TD Ameritrade platform, if you just threw in the symbol right here at the very top, let's, for instance, we're using Boeing. Boeing is at a share price at around $210 per share. This is basically a 180-day, 4-hour time frame. I use this time frame to basically come up with resistances, support lines, trend lines to give me an overall picture of what is happening with the stock or share price. So just going back here with the options, and we'll get more into basically the explanation of how charts are put together. Everything on the chart tells you something from candlesticks to price action based off of intraday supports and resistances. And we'll get more into that maybe in a later video, explain the different studies that we use here, simple moving averages, RSI, MACD, and all that good stuff. But our key takeaway here is we want to talk about options, if they're a good fit for the average person. I will tell you that they're very risky to trade. Call options and put options offer different strategies. Some people use call options or put options to hedge against other, let's say, open positions, sometimes against the market. There are so many opportunities to profit with options, but the risks are there. With a great reward comes great risk. I just want to make sure that everybody understands that each contract has a specific expiration date by which the holder must or might want to exercise their option. They don't have to. They have the obligation. They have the option, not the obligation, to exercise. The stated price on what you're buying. So if you're looking at a contract, let's say at a Boeing, if we're looking and we're thinking that Boeing is going to increase to a share price of $215 within a 1-month time frame, and that's totally speculating. I'm not implying any signals here. Very likely to happen based on the chart. But if we're looking at a 215 strike price, that is a call option that we're looking to purchase. That means we're anticipating a move to at least 215 or higher. We basically pay a premium to borrow a stock or a position, let's say Boeing. So one share of Boeing is $210. 100 shares of Boeing would be somewhere around $21,000. What's nice about options is you can use, or option contracts, you could pay a fraction of that share price to basically control 100 shares, right? Each contract consists of about 100 shares. And you can use that 100 shares option contract to leverage your money against a more expensive asset. So 100 shares of Boeing would be $21,000. But you might own an option contract that gives you the ability to, let's say, leverage an option on Boeing for a premium that's probably somewhere around a couple $100 to maybe $1,000, depending on how far in time you go out or what the implied volatility is on that option contract. You know, is the price trending higher? Is there more demand? Are the charts showing that there are greater demand, or basically a greater implication that the stock price will be trending to that level? So there's so many different things that go into an option contract and how to price the premium. So obviously, if there's a greater anticipation of the stock price going up, the premium will be higher. If we're going into, let's say, an earnings week and Boeing is expected to have some positive earnings report, and the implied volatility of the stock or push could be 10 or 15%, then you're going to pay a much higher premium to control that 100 shares of Boeing via option contract. So let's take a look here. We went over the premiums for you guys. Each contract has an expiration date. I will tell you that if the stock price or your strike price, let's say you bought Boeing at 210 and your strike price is 215, Boeing has to close above the 215 area before the expiration date or at expiration date for that contract to be worth anything. Basically, there's a break-even price. Your break-even price is simply what you pay for, right? Your premium that you pay to control that strike price. So if our 215 strike price gave us a, let's just say $25, option contract premium, then we're basically paying 25 times $100, okay, or 100 shares to move that asset. So let's just take a look here, and maybe this will better explain it for you guys. If we go back to the trade screen, we see Boeing here right through the center. Our most important part is the strike. I usually have it around 14 days. The 14-day strikes, 14 strike prices within the current price range. So 192, you got half on the bottom and half on the top above that 210 level. On the downside, the closer that you are in the money, so below the current price, that's called in the money or ITM. If you're sitting at 210 and you're trading a strike price, you're at the money, ATM. And if you're looking to buy an option contract out of the money, which is OTM, the closer or deeper that you are in the money, the more expensive the premium, since your break-even price above that strike price is more likely to begin your profits for you with a lower delta. So let's take a look here. The 215 strike price for a weekly contract, somewhere around $34. The bid and ask is 32 and 34. Your midpoint is going to be somewhere around $33. So if you're looking to basically enter at these prices, you could put in a bid. If you want to better execute, you might buy at the ask. There's different ways of doing that. So I'd like for option traders to understand that there's a lot of risk involved with weekly contracts. Again, the reason why weekly contracts look so enticing in terms of the premium cost is because it is less likely for a stock to move in either direction within that certain time frame. So it's less probable, not that it's impossible, but less probable that it'll cross that premium, cross that strike price, or to begin crossing that strike price within dollars for it to cause a premium push. which basically how you come up with your profits. So let's take a look here. There's a couple things I'd like to mention. These are a little more advanced, and I think somebody who's looking to trade options should understand the Greeks. Greeks are option risk metrics. So we'll just highlight a couple. We have delta, we have theta, we have gamma, and then we also have vega. So they all represent something. Delta represents the rate of change between the options price of $1 change and the underlying asset price. Okay. So it basically takes into consideration the sensitivity, right, of the option value relative to the underlying stock. So if the price is moving a certain direction, your delta might be a little bit higher. Okay. So this is a hedge ratio for neutral positions as well. There's different ways of using, like I said, option contracts to hedge against your portfolio overall. Theta represents the rate of change between the option price and time sensitivity. A lot of you guys already know what time decay is, right? Every day that the contract passes forward in time, it automatically decreases in value due to time decay, right? You pay a premium to basically have more time in your premium for a stock to hit your strike price. So theta does burn. The time decay as the option contract nears its expiration, a lot of theta would burn, especially if the stock is not moving significantly in the price that we're looking to strike to be. So whether you're going long or short on the stock, that can be very impactful to your option contract value. Gamma represents the rate of change between an options delta and the underlying stock. It's basically used to validate the change dramatically in response to even smaller movements. So if an option is moving at a higher value, more significantly, the gamma values are generally smaller as they're further away from the date of expiration. Vega, it represents the rate of change between an option value and the underlying asset's implied volatility. This is the option sensitivity to volatility, indicating the amount of option price given a 1% change in the the implied volatility. So for example, an option vega of 0.10 indicates that the option value is expected to change by 10 cents if the implied volatility changes by 1%. So they're running simultaneously to each other. There are some other Greeks, but we'll talk about them maybe more in a more advanced trading video. I just want you guys to basically get the understanding of what an option contract is. How are they used? Again, the risk to reward. These weekly options, just so everybody understands. Like I said, they're a lot less expensive than going further out. For instance, a 215 strike price for this Friday. Tomorrow is Friday. Let's say a weekly contract is trading around $32. This might have been around $150 in the beginning of the week. But as time passes by and the strike price has not been crossed over, then that option contract value burns or tends to burn a lot more. So let's just take a look here. This is a February 5th weekly contract. Let's take, for instance, a March 5th contract. And you'll see that same type of strike price of 215 is more expensive. Why? Because you're paying a lot more money to have basically the safety net of time that the underlying asset will move in the direction that you're speculating. So again, a 215 strike price is probably more likely to hit by March 5th than, let's just say, February 5th. So that's why the premium is a lot less here, because it's less likely to happen in such a short time frame, especially going into, let's say, tomorrow, the day of expiration for Boeing. Again, I'd love to share a lot more with you guys. In the meantime, this video is kind of an introduction video for us to understand basically what an option contract is, what to look for. A couple of things I like to look for, and very important, guys, when it comes to option contracts, and I might have missed this at the very beginning. Two things are very important to me. I like to look at open interest, which is OI, and then also volume. Volume is how many times the underlying contract is being traded or transacted in a single day. An option contract with a ton of volume means that there's a lot of people exchanging that contract, and for some reason they like that strike price within a certain time frame. The open interest is basically the people that are looking to invest in that strike price or hold that current strike price. The bigger the OI, which is open interest, and the more volume, the more likely you are to enter and exit your call option or put option because of liquidity, right? If there's not enough volume on that contract, you might have to sell at the bid rather than the ask. If the contract has a ton of volume, you might be able to sell at the ask and get filled, which is a much higher profit than the bid. The lighter the volume on the contract, the lighter the open interest, the more of a spread you're going to have between the bid and the ask. So let's say you're in this contract right here, 215. The bid is 32 and 34. I'm sure there's a little bit of volume on that contract because the spreads are pretty close. But if not, then you might see 32 is the bid and maybe the ask is 50. Vice versa. If you're looking to purchase, you might have to pay at the ask rather than having a tighter spread here between the bid and the ask. And that's based on liquidity, like I said, volume, open interest. Thank you guys again for watching this video. I hope to basically, see you at a later time. If you guys have any other questions, drop a comment in the link below or even in the private group Discord, and we'll be able to touch base. See you guys. Thank you.